everybody. Jeffrey Benyon here with Safe Option Strategies. Welcome to today's episode of the Moving Markets Podcast. Yesterday I took a victory lap and patted myself on the back and congratulated myself about what I predicted Monday would happen, or actually Friday, what would happen if the CPI numbers came in the way they did, and then the market reacted exactly like I thought. So I took a victory lap for that yesterday. Today, I have to be honest. I don't get as much of a victory lap because yesterday I said that I thought we would either sell off more or have a much, much bigger rebound than we did. We got a rebound today. The three major indexes were up, and we'll take that anytime we can get it. But I'll fess up when I'm wrong. It was not nearly as big a rally as what I thought it would be. There was still some FOMO and some buy the dip, and we're going to talk about that a little bit as we discuss what the markets did, and once again go over what's coming up in the next few days and maybe over the weekend. So enjoy today's episode, and happy Valentine's Day to everybody. Let's look at the adjustment that I just sent out for JP Morgan. By the time you're listening to this, hopefully you have already seen this adjustment. Now remember, yesterday, having either allowed some short puts to expire or bought to close them for just a few pennies. I know some people did both. We sent out an adjustment last week and said, go ahead and buy to close the short puts, just get rid of them just in case. We didn't want to risk that maybe stock would get put to us at that price. But some people just went until the end of the week last week, went until Friday and allowed those short puts to expire. So whichever one you did, we added new short puts this morning at the open. Right now, the value of our short puts that expire at the end of this week and the value of our long puts that expire at the end of this week are identical. Both are worth 4 cents a share right now. I'm just going to leave those alone. My intention right now is to either let them expire worthless at the end of this week, or if something happens tomorrow and Friday, and we're going to talk about that in a minute about what I think could happen, then we will allow those puts to help offset some potential loss in the position if that ends up being the case. So for now, we're going to leave the puts alone. What we're going to do is sell to close the 175 strike long calls, buy to close the 177.50 short calls, and simply reopen them. Same strike price for the long call, same strike price for the short call. We're just moving them out to next Friday. We're moving them away from this Friday to next Friday. It's only going to add 11 or 12 cents of debit to our trade. Now, obviously, some of that depends on where the market opens right now. I'm putting a 12 cent per share limit debit order. Tomorrow morning, if pre-market shows JP Morgan up a lot, or if it shows JP Morgan down a lot in pre-market, and again, I'll tell you in a couple of minutes why that is a possibility. But depending on what pre-market is doing, we may adjust this limit order. We may look at it and say, hey, there's no reason to pay 12 cents. We might be able to do this roll for 5 cents. We might see something different going on and say, wow, this roll that we thought was going to be no more than 11 or 12 cents could potentially be 25 or 30 or 40 cents. And that would change the dynamic. We might not do the adjustment if it were to be that far off. So some of what we do will depend a little bit on what futures are like tomorrow morning and what's going on at the open of the market. If JP Morgan Chase is surging to the upside tomorrow morning, right now at this moment in time, the trade is just a fraction off of break even. I mean, depending on how many contracts you might have done in your portfolio, you might be anywhere from a few dollars to no more than $30 or $40, and that's to the downside. And that's if you're doing quite a few contracts. There would be nothing wrong at all. And I hope you read this in the text of the email, because it's not on this. It's not on the PDF that you see on the adjustment, but it's in the text of the actual email that I sent out. I hope you read it carefully. You've got two choices tomorrow morning. Do the adjustment like we have it right here, or the other choice would be close the trade and take a small loss. It would be a very small loss. Look, you all know, anyone who's followed me for a while, anyone who's been a member of Safe Option Strategies for a while, I hate losing money. I'm never happy about taking a loss, but sometimes that is the most prudent thing to do. We could make this adjustment out to next week and then have this thing go horribly against us and then have to make another adjustment to not lose a lot of money. And, they're adjusting this out tomorrow increases our potential reward, but it also increases our risk. So higher risk, higher reward. That's something you've got to take into consideration. You've got to think about what your personal risk tolerance is. If you have a high risk tolerance, you don't have a lot of contracts in this trade, roll it out. If your risk tolerance is very low and you can live with a very small loss, then get out tomorrow morning with a very small loss. There is no reason to stay in this trade if it's going to cause you stress and panic. And instead, you can get out tomorrow morning for $5 to $50 loss. We are profitable on every trade we've closed since the start of this year. We've got a couple of newer trades that are down a little bit, but not very much. I have high expectations that both of them will be very profitable trades. If out of our first 7 or 8 trades we placed, we had a really small, almost break even type scenario, small loss break even on one of them, we're doing fantastic. We're crushing it. We're exactly having the kind of results and seeing what we want to see. So that is the adjustment. If you're following along in the SOS spreadsheet, if you use this on a regular basis, what we're doing is basically um, selling to close this 175 strike call, buying to open the 175 strike call 1 week farther out in expiration, and then doing the same thing with this short sale. Buying to close it, moving it 1 week farther out in expiration. And as you can see here, the short put and the long put right now today are worth exactly the same amount of money. I don't expect that to be dramatically different tomorrow unless pre-market JP Morgan is selling off $2, $3, $4 a share, in which case the put side of that trade, by leaving it open, it could actually salvage us taking any bigger of a loss. So that's what it'll look like if you're doing that. Like I said, be prudent, be smart. If the risk on your end is not worth the potential reward on it, close the trade. Nothing to be ashamed of, nothing wrong with that. If you can handle a little more risk tolerance and increase the probability that we, or at least the possibility that we get out of the trade with some profit, make the rollout, and then watch Discord tomorrow. Make sure you're on the Discord channel so that if I give an update based on what's going on pre-market, you'll see what that is. All right. With that out of the way, no adjustments to caller trades right now. None of our other trades need to be adjusted right now. By the way, I'll this on the website for tomorrow morning. The Home Depot trade that I sent out for those of you that were watching Discord today, the Home Depot long iron condor in anticipation of their earnings next week, I believe Tuesday, maybe Wednesday. I did get filled on that, so I will add that to the spreadsheet as an additional trade beyond the weekly ones. I got it actually a pretty good fill price because the mid price was bouncing around a lot on that one, and eventually it went down below my limit order long enough for me to get filled in the trade. By the end of the day, that trade just opened up around the middle of the trading day today. By the end of the day, I was 14, 15% profitable in that trade and really tempted to try and close it out. But when I put a limit order in to try and get it to close for 15% on a less than a 1 day trade, I just didn't get filled. The mid price was bouncing around too much. So, but that's just as a kind of a side note. All right. As you can see, the Dow Jones Industrial Average had a nice update today, almost 0.5%. The S&P almost a full percent, and the Nasdaq 1.33%. And then we don't talk a lot about or follow the Russell 2000, what's considered the small business index, but it had a phenomenal day, especially from a percentage standpoint. So all of the indexes up very nicely today. Yesterday, I took a big victory lap. I patted myself on the back. I said, man, when I spoke on Monday, when I did this podcast on Monday and told you what I thought could happen with CPI and what the reaction would be to the market, I nailed it. I hit it right on the head. I took my victory lap yesterday. I got to eat a little bit of crow. I sort of got right what I thought would happen, but not nearly to the degree that I thought it would happen. I thought today, if the indexes started a rebound, I thought it would be huge and we'd get back most of what we lost yesterday. 151 is only a small part of the 500 plus we lost yesterday. Or I thought, and I didn't want to predict which it would be, but I thought we either have a really big update getting back most of what we lost yesterday, or have a really big down day and a big slide today, and or continuation of the slide from yesterday. And we kind of split the middle. We had a rebound, but not nearly as big a rebound as I predicted. So I'm willing to fess up, and when I'm wrong about what I thought was going to happen, I don't mind saying it and admitting to it. And today I was wrong in what I thought would happen. We did get a rebound, but not nearly the kind of rebound that I thought we would get. Now, today was a small news day. There wasn't a lot going on today. There wasn't a lot to get excited about or get down about. It was just purely some of that FOMO that we talked about yesterday, and some people wanting to get back in and not take the risk of missing that next jump to the upside. As you can see, today was just a very light day as far as news. Much different scenario tomorrow. You've got all five of these reports are going to break around 8:30 a.m. Eastern time. That's 6:30 in the morning my time. That is one full hour before the U.S. markets open. Jobless claims, of course, week to week. That's always something that we're looking at to see how healthy is the jobs market. A lot of last year, when there were economic headwinds with inflation, and the year before, the market tended to keep going up primarily because of a strong jobs market and a strong consumer. And those, we're going to get a glimpse at both of those in those 8:30 a.m. reports, job claims and retail sales. This is going to be big tomorrow. If either or both of these start to show some chinks in the armor, be prepared, especially if both of them show it. If the new jobless claims comes in a little higher than expected, if the retail sales is not as strong as expected, both of those would be bad news for the economy and bad news for the inflation picture. And if both of those showed the same thing or painted the same picture, you're going to see a sell-off tomorrow, maybe equal to or greater than what we saw on Tuesday. And I know that sounds a little bit sensationalized, but be prepared for that. That is a strong possibility. You add to that a Philadelphia Fed, which is expected to be a little bit weak, and an Empire States Manufacturing Index. These are regional manufacturing looks. You get a look at what companies are doing and manufacturing output is in a couple of large populated areas in the country, because they tend to be a forecast of a more macro look at what's going on with manufacturing. And if those show weakness, in addition to retail sales weakness and higher jobless claims, you get, I'd like to say trifecta, but it's really, there's four or five things here, so I can't say trifecta. But if you get three or four of these five reports right here, all painting the same picture, and that is weakness in the economy compared to what is expected, you're going to see a massive sell-off. Now, if it's the other way around, if three out of these five or four out of these five are showing good news, if the reports are better than what the expectation is, which would be fewer new jobless claims, better than expected retail sales, better than expected Philadelphia manufacturing, better than expected New York Empire State, by the way, is New York. For those of you, middle America where I'm at, that might not know that. If those are all better than what's expected, you could see a continuation of today's rally. But I'm not going to go out on the limb to the extent that I did yesterday and say we're going to get back the rest of what we gave up on Tuesday. I think you would see a cautious extension of the rally we got today. There's still a lot of FOMO. There's still people that want to get in and not miss that next big breakout. And so you've got to anticipate that that's going to happen. Tech stocks did fantastic today. My personal portfolio did really well today, and didn't do horrible on Tuesday because a lot of stuff is hedged, but it did well today, and got back a good portion of what it gave up on Tuesday. So I'm hopeful. That my expectation is low on all of these. I think at least three or four, if not all five of these reports right here, are going to miss the mark tomorrow and be worse than what is anticipated. If I'm right on that, I'm prepared for a pretty ugly day. If I'm wrong on that, I'm never going to be upset by a bullish move in the market. I would prefer a bullish move, but I'm well protected and well hedged, and you should be as well if you follow the program. Friday, all eyes are going to be on PPI. I know for some people that follow real estate a little bit more, that maybe have some real estate stocks in their portfolio, maybe some bank stocks that do a lot of mortgages, the housing starts on Friday is not inconsequential. But all eyes are going to be on PPI. It's going to be the same focus that CPI had on Tuesday morning. And if those numbers are worse than what the expectation is, even by a fraction, like it was on Tuesday, you're going to see this week end pretty ugly, and you need to be prepared for that. Real quick programming note: I'm sure all of you are aware that President's Day is this upcoming Monday. The U.S. stock market will be closed, and that means I will be off. I will most likely be skiing or snowboarding at one of my favorite local resorts, because that's what I love to do with my time off during the wintertime. So be aware, we will not be sending a Signal newsletter with a new trade. We will not be doing a podcast that day. I will not be online that morning. But all of those things that we normally do each and every Monday, we will simply do those on Tuesday next week instead of on Monday. So just be aware of that. I'll try and give you one more reminder tomorrow and another one on Friday, just so that everyone's aware. In the meantime, I hope everyone had a great Wednesday. I hope you have a great Thursday, and we'll see you back here for tomorrow's podcast. Thanks. Bye-bye.